Welcome to today's Canary Report. Markets are roaring ahead of a potential rate hike, even as Kevin Warsh's comments spark fresh anxiety about the Federal Reserve's next move. Let's see what our canaries are telling us. Speculative sentiment remains aggressively bullish today, with every major spec tracker posting gains as risk capital flows back into tech and growth. ARKK climbed nearly 1%, while SPHB surged over 1 point, reflecting renewed confidence in the Magnificent Seven narrative despite broader economic chatter. Investors are clearly willing to pay for momentum right now, treating any macro noise as a buying opportunity rather than a distraction. Credit markets showed surprising resilience amid the hawkish headlines, with high-yield trackers like HIGH and HYG all advancing on the day. Even as Kevin Warsh's comments hint at a more aggressive path for monetary policy, borrowing costs haven't spiked into panic territory yet. This suggests investors are pricing in higher rates without expecting an immediate liquidity crunch, keeping spreads tight despite the volatility overhead. Volatility remains contained even if the VIX index ticked up slightly above 16 points. The fear gauges UVXY, VIXY and VXX retreated as downside protection wasn't needed in the immediate moment. While Kevin Warsh's comments created a ripple effect of uncertainty, market participants viewed it more as noise than signal, resulting in lower demand for short-term vol leverage today. The real economy engines are humming louder than they have in weeks, led by a sharp 3.75% rally in semiconductor and hardware exposure through SMH. This aligns with the heavy tech news flow and indicates that capital rotation is favoring hard assets over soft services right now. Even the small cap indices like IWM and RSP managed positive ground, suggesting the optimism isn't confined to just a few oversized names, but has filtered down into broader industrial demand. The safety trade showed mixed signals as traditional hedges, like gold and consumer staples, dipped alongside the broader market rally. Gold fell over 1.5% despite the macro headwinds, likely weighed down by dollar strength rather than pure fear of recession. Meanwhile, long-term treasuries moved higher, indicating that while immediate risk is priced in, longer-dated investors are still looking for yield stability against potential Fed tightening. In summary, today's session paints a picture of a market that has absorbed hawkish rhetoric without breaking its bullish structure. Speculative energy is high, driven by tech leadership and strong sector performance, while credit remains stable enough to support continued risk-taking. The only lingering question is how long this confidence lasts before the Fed narrative fully takes hold in pricing models. That's your Canary Report for today. Keep an eye on Warsh's next move, but don't let one headline shake your portfolio allocation. We'll see you tomorrow.